when a stock rockets from 83 bucks to, well, near its all-time high, you really have to ask yourself, is it screaming strong buy, or is it a perfectly disguised value trap waiting to catch retail traders?
Yeah, that's the big question right now.
Exactly. I mean, if you are holding advanced micro devices or AMD in your portfolio right now, or even just thinking about it, you are sitting right at the absolute center of a massive market tug of war.
It's a huge battle of narratives.
It is. So we are tearing into that paradox today. And hey, if you want to help us out in this tug of war, hitting that like button, subscribing to our YouTube channel, and dropping your feedback in the comments is, well, practically mandatory.
Right. We really do read every single one.
We absolutely do. We want to know exactly where you stand. So today is Wednesday, April 15th, 2026. AMD is sitting at $258.12, up about 1.20% on the day. And our mission here is to just cut through all the noise.
Yeah, we're going to rip apart the financials, decode the technical signals, and, really weigh the ultimate bull versus bear case.
Right. But before we get into the weeds, you know the drill.
I do. Look, we are here to dissect the data, right? The underlying mechanisms and psychology driving this stock. This is an analytical deep dive. It is definitely not financial advice. Your portfolio is your responsibility.
Exactly. So let's start with the foundation, because, I mean, you don't get a move from a 52-week low of $83.75 all the way up to near a 52-week high of $267.08 on just hype alone.
No, you really don't.
There has to be a real tangible financial engine driving that kind of explosive momentum, right?
There absolutely is. And the causality behind that price floor, well, it's found in their fiscal year 2025 income statement. The headline numbers are just, they're aggressive.
How aggressive are we talking?
So total revenue hit a record $34.64 billion.
Wow.
Yeah, which is a 34% year-over-year increase. And you have to remember the sheer scale of AMD here.
Right, they're massive.
Exactly. Growing top-line revenue by a third at that kind of market capitalization, I mean, that requires taking serious market share.
Wait, let me stop you right there, though, because, top-line revenue is great for headlines, but I want to know how much of that actually trickles down.
Fair point.
Like, what does the bottom line actually look like, and how are they structuring it?
Well, net income hit $4.34 billion on a generally accepted accounting principles basis, or GAAP.
Okay.
But their adjusted net income reached $6.86 billion. Operating income came in at $3.74 billion. And for earnings per share, we're looking at $2.65 GAAP and $4.17 adjusted.
The gap between GAAP and adjusted always makes me raise an eyebrow.
Oh, absolutely.
It's usually where companies hide their dirty laundry, right?
Yeah.
So what are the actual mechanics of that discrepancy here? What are they stripping out to make that adjusted number look so much better?
So the primary driver of that difference in the tech sector, and specifically for AMD, is stock-based compensation.
Ah, right. Paying employees in stock.
Yeah. To attract top-tier engineering talent in the middle of an AI arms race against Nvidia, you have to pay them in equity.
Makes total sense.
Right. And GAAP requires companies to count that stock distribution as an expense. But the adjusted metric strips it out, arguing it's just a non-cash expense.
So they are basically preserving their cash by handing out shares.
Exactly.
That's brilliant for the corporate bank account, sure. But if I'm a retail investor, that means my slice of the pie is constantly being diluted to pay their developers.
Yeah, that is the necessary trade-off. You are being diluted, but that cash preservation is what builds their balance sheet. And when we look at that balance sheet, it's incredibly strong.
How strong?
Total assets sit at $76.93 billion against only $13.93 billion in liabilities.
Oh, wow.
Yeah, total equity is $63 billion, and they hold a highly liquid cash position of $5.56 billion.
Okay, so the underlying structure is basically impenetrable. I mean, a nearly 5-to-1 ratio of assets to liabilities is a financial fortress.
It really is.
But I want to talk about how that fortress actually functions in a war zone, because the semiconductor industry requires just a terrifying amount of capital to survive.
It does. Which brings us to the most vital metric of all, which is cash flow. So cash from operations is $7.71 billion.
Okay.
But more importantly, total free cash flow grew by an astronomical 129% year over year to $5.52 billion.
Wait, walk me through the mechanism of that. How does a massive legacy hardware company suddenly double its free cash flow in a single year?
It really comes down to product mix and margins. AMD isn't just selling cheap consumer chips anymore.
Right.
They have been systematically capturing market share from Intel in the high-margin enterprise data center space with their EPYC server processors.
Oh, so they're selling the premium stuff now.
Exactly. When you sell premium high-margin silicon to cloud providers, Your free cash flow scales exponentially relative to your operating costs.
That makes a lot of sense.
Right, and that $5.52 billion in free cash flow, that is the war chest they need to fund the research and development for the next generation of AI chips.
I see the logic there. The 2025 financial fortress is fully funded. But look, markets don't buy the past, they buy the future.
Absolutely true.
A brilliant 2025 doesn't automatically justify a stock price that has effectively tripled from its lows. We need to look at what the algorithms and the institutions are doing with the stock right now.
And that is where the current market behavior becomes incredibly complex. Technically speaking, AMD is in a strong, undeniable uptrend.
Yeah, the charts look wild.
They do. All of the major moving averages are aligned bullishly. The 5-day moving average is at $255.37. The 50-day is at $209.85, and the 200-day is at $201.06.
The fact that the current price is sitting $50 above the 200-day moving average tells me the stock is running really hot.
Very hot.
So what is the momentum actually looking like under the surface?
We can measure that momentum using the MACD, right? The moving average convergence divergence. Right now, it's sitting at 4.87.
Okay, I know traders live and die by the MACD, but let's explain the actual mechanism for the listener. Why does a 4.87 signal a continued buy trend?
Sure. So the MACD works by subtracting a longer-term moving average from a shorter-term one. When the short-term trend diverges and accelerates upward away from the long-term trend, the MACD value becomes positive.
Got it.
So a reading of 4.87 means the short-term buying pressure is aggressively outpacing the historical average. The buyers are completely in control.
So if the buyers are in control, what is the ceiling? I mean, if I'm looking at the chart, the immediate resistance is that all-time high of $267.08.
Yes.
If it breaks through that, there is no historical price data left. It's just open air. On the flip side, though, if this momentum stalls, where is the floor?
Well, the primary downside support sits at $240.12, which perfectly aligns with that 50-day moving average.
Okay.
If that breaks, there is a strong psychological support level at $225.
Mm.
But before you look at price targets, you really have to look at exhaustion.
Exhaustion.
Yeah, the Relative Strength Index, or RSI 14, is currently flashing a bright warning light at 71.93.
Let's break down the RSI for anyone not staring at a trading terminal right now.
Right, so the RSI measures the speed and magnitude of recent price changes on a scale from 0 to 100. It essentially calculates the ratio of upward price movements to downward price movements over a 14-day period.
And 71.93 is pretty high.
Very. Anything over 70 indicates that the asset is overbought. It means the buying velocity has been so intense for so long that the buyers are mathematically likely to be exhausted.
So it signals severe vulnerability to a short-term pullback.
Exactly.
That brings us to the million-dollar question then. Who is actually ignoring that overbought signal and driving this price action?
Well, professional order flow analysis reveals aggressive institutional accumulation right around the $250 level.
Okay, so the big players.
Yeah, the major hedge funds and asset managers are essentially treating any minor dip as a buying opportunity. But, and this is a big but, we have a glaring contradiction when we look at insider activity.
What kind of contradiction?
There is heavy, sustained insider selling.
Wait, let's put some numbers on heavy. How much are the people inside the building actually dumping?
Between February and March of 2026, CEO Lisa Su disposed of roughly 210,000 shares at prices ranging between $197 and $219.
Wow.
And just a few days ago, on April 6, Chief Technology Officer Mark Papermaster sold 3,293 shares at $225. And arguably the most critical data point here, we have seen zero significant open market buying by any insiders in recent months.
Wait, let's unpack this. If the institutional algorithms are backing up the truck at $250, but the literal architects of the company, the CEO and CTO, are bailing out of hundreds of thousands of shares in the low $200, I mean, one of them is completely wrong.
It certainly seems that way.
Wall Street is experiencing total FOMO, while the people who actually know what the next product cycle looks like are taking millions of dollars off the table. Is the smart money actually dumb here?
It's the ultimate market paradox, really. Institutional buyers operate on macroeconomic trends. They see the AI sector expanding, they have billions of dollars of capital they are mandated to deploy, and AMD is one of the only viable alternatives to Nvidia.
So they're basically forced to buy.
Exactly. Insiders, conversely, are managing personal concentration risk. Much of their net worth is tied up in the company, so they diversify.
I understand personal risk management, but timing matters. Selling 210,000 shares into a massive rally doesn't exactly scream confidence in the immediate upside.
Right, which pushes us directly into the core valuation debate.
Let's go there. If Wall Street is buying and insiders are selling, what is this company actually worth? Are we looking at an undervalued gem or a trap?
Well, the broader analyst consensus remains a moderate buy. We have 37 buy ratings, 12 holds, and 0 sells.
Zero sells.
Zero. The average price target from these analysts is $289.35, with the most aggressive bull target sitting at $365.
Okay, zero sell ratings across 49 major analysts. That borders on hubris, honestly.
It's definitely optimistic.
But analyst targets are just opinions. What do the actual mathematical valuation models say?
This is where we see two wildly different narratives based on the specific mechanism you use to value the company.
Okay, lay them out.
The argument that AMD is undervalued relies heavily on discounted cash flow, or DCF, models. Simply, Wall St. ran a DCF model that suggests AMD's intrinsic value is actually $318.80.
Oh, wow.
Yeah. If that math holds, the current price of $258 means it's still roughly 20% undervalued.
Let's unpack the mechanics of a DCF model so we aren't just treating $318 as a magical number. How does that model actually arrive at that valuation?
Basically, a DCF model attempts to calculate the absolute true value of a business by projecting exactly how much free cash flow the company will generate from today until the end of time.
The end of time, all right.
Right, and then it discounts all that future cash back to its present value. The discount rate accounts for inflation, the riskiness of the business, and the opportunity cost of not investing that money elsewhere.
So the model is essentially saying that the future rivers of cash AMD will generate from AI data centers justify a $318 price tag today.
That is exactly what it's saying.
But that requires trusting a projection of cash flows years into the future. In an industry where technology becomes obsolete every 18 months, what is the counter argument here? What does the value trap side of the equation look like?
The value trap argument ignores distant future projections and focuses strictly on what you are paying for the company's actual earnings right now.
Which is?
AMD's trailing price to earnings, or PE ratio, is currently a sky-high 96.7x.
Yeah, a 97x PE ratio completely alters the risk profile. To put that into perspective for you, a 97x PE means that if AMD took every single penny of their profit and paid it out to you as a dividend, it would take you 97 years just to make your initial investment back.
It's a massive premium.
You aren't just buying a luxury car here.
Yeah.
You're paying hypercar prices, and you're paying for that hypercar with a 100-year mortgage. It requires a full century of absolutely flawless driving.
Flawless is the operative word there. A 96.7x PE completely strips away your margin of safety.
Right. If there is even a single scratch on the bumper, any flaw in execution, the value is going to tank.
Exactly. It demands absolute perfection in their upcoming product ramps. And the reality is, perfection is already under threat.
How so?
Well, there is currently a sequential 5% revenue drop projected for the first quarter of 2026.
And that explains exactly why retail traders get slaughtered in setups like this, doesn't it?
Oh, 100%.
You see the stock rocket from 83 to 260, you feel the FOMO, you buy the momentum right at the $267 resistance level, completely ignoring that the RSI is flashing an overbought warning and that you are paying a 97-year premium on earnings.
They get lured in by the price action without understanding the underlying mechanics of the valuation. And because you are paying for perfection, the entire thesis for owning AMD doesn't rest on that incredible 2025 income statement we discussed earlier.
Right. The past is the past.
Exactly. It rests entirely on specific future catalysts and their ability to navigate some brutal macroeconomic landmines.
So let's lay out those two futures. What does the ultimate best case bull narrative look like from here? How did they possibly justify a 97x PE?
The bull case requires AMD to become the undisputed co-king of the AI infrastructure space. Their long-term outlook is incredibly aggressive.
What are the targets?
They are targeting a 60% compound annual growth rate, or CAGR, in data center revenue through the year 2030.
Wait, growing your most important business segment by 60% every single year for 4 years is a monumental task.
It's massive.
How do they mechanically achieve that?
The primary catalysts are slated for the second half of 2026. This hinges on the launch of the MI450 GPU and, crucially, their Helios rack-scale platform.
Okay.
What you have to understand is the paradigm shift in the semiconductor industry. They are no longer just selling a chip to be slotted into another board. They are shifting to selling entire, integrated, multi-gigawatt AI ecosystems.
So they are like moving from selling components to selling the entire factory.
Precisely. Nvidia dominated early because they provided the hardware and the software network. AMD is replicating that ecosystem approach with Helios. And the bull case is supported by massive traction. I mean, they have already secured multi-gigawatt GPU supply deals with hyperscale titans like OpenAI and Meta.
Oh, wow.
Yeah, combine that with their continued cannibalization of Intel's traditional server CPU market, and the pathway to that 60% CGR becomes mathematically visible.
I see the pathway, definitely. But let me challenge this. We are banking almost the entire valuation on this MI450 chip and the Helios platform being an absolute slam dunk in the second half of 2026.
We are.
What happens if they stumble? Like, what is the bear narrative?
The bear narrative is a brutal combination of geopolitical restriction and execution failure.
Let's start with the geopolitics.
Okay, so the first major landline is China. The existing U.S. export controls on their previous generation MI308 chips severely capped their global revenue potential in 2025.
Right, and with those export restrictions already chopping a huge piece out of the pot.
Exactly. That geopolitical headwind is a structural reality that just isn't going away.
You can't engineer your way around federal trade restrictions.
No, you can't.
But what about the things they actually can control inside the building?
That is where the massive execution risk comes into play. Because they are fighting an all-out war with Nvidia, their operating expenses are rising rapidly to fund research and development.
Okay.
If there is even a single quarter delay in ramping up production of the MI450 in late 2026, those high operating expenses will immediately crush their profit margins.
Aren't we essentially putting all our chips on a very narrow roulette number here? Like, if Meta or OpenAI decide to start designing their own custom silicon in-house to save money, or if Taiwan Semiconductor has a manufacturing hiccup and delays the MI450, I mean, that 97x PE ratio is going to compress violently.
That is the exact vulnerability the bears are highlighting. Furthermore, AMD still relies heavily on their semi-custom business, which powers gaming consoles like the PlayStation and Xbox.
Oh, right, the console cycle.
Exactly. As the current generation of consoles matures, that segment is facing a cyclical revenue decline. If the console money dries up at the exact moment their AI R&D expenses peak, the cash flow mathematics get very ugly, very quickly.
Man, so we have a company with an impenetrable balance sheet today, trading at an astronomical premium, facing a future that demands flawless execution in a really volatile geopolitical climate.
That sums it up perfectly.
Synthesize this for us. Where does this leave the stock?
The outlook for AMD is fundamentally a study in conflicting time horizons. In the short term, the landscape is fraught with turbulence.
Right.
The technical indicators, particularly that overbought RSI at 71.93, suggest the stock is highly vulnerable to a pullback. We could easily see support tested in that $255 to $260 range, or even down to $240 if the broader market flinches.
So if you are trading this on a 3-month horizon, you are playing with fire.
You are. But if you shift your lens to a 3-year horizon, the underlying narrative of the AI data center remains structurally bullish.
Assuming they execute.
Yes. If AMD successfully executes the MI450 rollout and captures that 60% compound annual growth rate in the enterprise sector, a $258 entry point might eventually be viewed as a discount, perfectly in line with that $318 DCF valuation model.
So it entirely depends on whether you are trading momentum today or investing in infrastructure tomorrow.
That is exactly it.
And that is exactly why you have to look under the hood of the metrics, not just at the headline price. As we wrap up this deep dive, I want to emphasize one more time everything we've broken down today. The cash flow drivers, the institutional algorithms, the geopolitical risks. It is our analysis of the market data.
Right. It is absolutely not financial advice.
Please do your own research before you allocate a single dollar.
The data provides the context, but the market decides the price.
And speaking of context, I want to leave you with one final lingering thought to chew on. The complex discounted cash flow models tell us the intrinsic mathematical value of this stock is almost $319.
They do.
But the CEO, the visionary, literally commanding the engineers who are building these ultimate AI chips, chose to sell hundreds of thousands of her personal shares under $220. If the very people building the hardware for the future are quietly taking their personal chips off the table, well, what does that tell you about the invincibility of the AI supercycle we are all being blindly told to trust?
It's a great question.
Let us know what you think. Hit the YouTube comments and debate your own bull or bear case for AMD. We'll see you in the next deep dive.